I'll ask Liam and Mark to come back on screen. We're going to have a bit more of a discussion. There's a few questions coming through. Maybe the first one is we've actually got a question going through to concerning Absa. So I guess either Mark or Liam can take this on. They're both financial services experts. But in that graph, Absa seemed to have quite a low price to book relative to its ROE. So it appeared to offer a little bit of value. Is that the way we're seeing it? How do you view Absa?
Mark, do you want to take this?
I was wondering if you.
I don't mind.
That's fine.
Because I've looked at that regression a lot over the last 7 years. I mean, it's something that I've always used as it's just a bit of an underpin or a sanity check, I think. Mm-hmm. That regression has. I'll tell you what's consistently come across is that First Rand has consistently appeared marginally overvalued, and the likes of Absa and Nedbank have often appeared to offer quite good value. So that's not something that I would say is an anomaly that's just come out recently. Absa optically is cheap, correct, but these businesses also when we went back to that old mutual versus Sanlam discussion, you have to take management's track record into account when creating your future expectations. And Absa is one of the financial services businesses in South Africa that has got quite a checkered track record in terms of stability at the core, in terms of their key personnel and management, and has been quite an inconsistent performer in terms of delivering versus expectations, I would say. So those would be the things that would probably add to the fact that it looks optically cheap on that regression.
I think, Liam, I would probably add the point that, certainly in the many, many years that I've been covering banks, I've tended to perceive Absa as the sort of franchise that started out very strong in the early 2000s and has been sort of donating market share to everyone else. Obviously, the period it spent as part of the Barclays group and then sort of cast out into the cold certainly hasn't helped, which has sort of undermined confidence of investors in its future. But that probably just adds a bit of color to the points Liam's made on that issue.
Perhaps just before we answer the next question, just to remind everybody that if you do want to ask a question, there's a chat function at the bottom, and please to type it in now. Maybe just one or two pre-recorded questions. Mike, while you are on the banks, and we have a COVID question, that we have a question around the reserves that banks have been forced to put into place around COVID. And obviously we've seen some banks coming out with atrocious results. Do you feel that this is priced into the market, or is there a big opportunity you see forward for South African banks?
So thanks, Dale, for that. And if you cast your mind back to the chart we showed of the return on equity versus price to book over time, you may recall that the last sets of results, you've seen both the return on equity absolutely collapse and the ratings collapse at the same time. And the principal reason that has happened is the creation of those reserves that Dale was asking about. So, they've all had to raise significant provisions. And typically, I think what you can trust is that from a regulatory perspective, the way this is approached is from a fairly conservative perspective. So you raise conservatively, and then, the decisions you make around potentially releasing those reserves is done on a very judicious and cautious basis. I would say that, the progression out of COVID has certainly been a lot better and a lot quicker, dare I say it, than what we might have thought. As we, right now, if you think about it, we're at literally the 1-year anniversary of market lows and the depths of lockdown. And the main thing is that this vaccine has come through a hell of a lot quicker than I think any of us would have hoped. So, I'm pretty confident that the reserving is going to prove to be adequate, mainly on the basis that I think the road out of COVID is now clear. And in fact, you've already seen offshore a number of the banks actually starting to just beginning to release provisions, and certainly very little evidence of further provisions needing to be raised. So, yes, I think they are adequately provisioned, and I think you're going to see the improvement in returns going forward which does make the bank sector from current levels, I think, a reasonably good recovery play in a post-COVID world.
Thanks, Mike. Liam, a question for you, because I know this is a speciality of yours. One of the questions coming through is, what seems to be some of the attributes that consistently come through from successful management teams in the financial services space? Is there teams of people that have similar attributes and you can pick that up as winners in the financial services space?
Yeah, so I would say that yes, there is. So you could almost back them out. You could say which financial services companies in South Africa have consistently given shareholders good returns on capital. Try and back out the types of common threads that come through in those management teams, and certainly the more entrepreneurial ones in South Africa have tended to be able to take market share more recently, probably in the last 10 years in quite mature industries in South Africa. They were able to eke out growth above the GDP in South Africa, whereas companies like Mike was alluding to, Absa and maybe like a Nedbank have bled market share because management teams haven't necessarily reacted as quickly or stayed ahead of the pack. And I would put the better ones at a company like Outsurance, which is inside RMI, FirstRand, which is stands out around the world as one of the better run banks, Transaction Capital in South Africa, and I mean, credit has to be given to Capitec in the way that they've attacked their sort of markets that they operate in. So that entrepreneurial type of theme comes through quite strongly in businesses that have been able to grow. But I mean, once again, like going back to the basic good attributes of management teams, humility in the way that they communicate, under promising, over delivering, not necessarily unreasonable under promising. Shareholders still have to hold them accountable, but in terms of the expectations that they create in the market, they're often very measured in their approach, and it also comes through quite strongly in their accounting treatment of things. So earnings quality is something that's analyzed quite heavily by analysts on banks, because there's so many assumptions that come through in terms of particularly the bad loans books and things like that. You have to create an expectation of the future there. And the management teams that have consistently been shown to be conservative in their approach have been rewarded. I guess once again also a good temperament through cycles. So if I think back to 2014, 2015, go into a bank's meeting and everyone will be telling you how they have no exposure to the resource sector in South Africa because that was a popular thing to say at the time. But actually, that was a good time to be extending your balance sheet, at the lows into some of those sectors and creating some kind of counter cyclicality within your lending stream. So, like that stuff only comes through later on. But I guess it all filters into like a level-headed, humility, that kind of golden thread that comes through with these management teams.
Thank you, Liam. I see the rest of the questions are very much based for Henry and for Peter. So Peter and Henry, if you wouldn't mind trying to get through as many of those questions as you can.
Yeah, there's kind of two streams of questions. This presentation has obviously got kind of two parts to it. One is the market, and the other one is financial advisors and their businesses and valuations. I think one of the questions is about the life stage of a business. A younger business may not be profitable. So guys have established something. I mean, my basic advice would be for people to build up some value. Don't try and do a transaction too early. On the other hand, join in our private client business, we've got a platform where people come on and effectively they've got their own business that they run on a platform. So you don't necessarily have to start your own business up. But we from an anchor perspective, we're an asset management business. We manage some assets. We provide product which might or might not be appropriate for some of these clients. The financial advisor has got to decide. But the key thing, and it ties back kind of to what Liam was saying, it's the quality of management. I always say one good person is worth 10 average people. We're interested in partnering with and working with people who can create value for their clients, can look after clients and grow the book. there's a question about an exit strategy for people who have a practice embedded in a larger financial services group if they'd like to exit. I think we're very responsible industry players. I think it depends very much on how somebody's, the contract that they've got and what the spirit of the agreement that they have with a big player. We're interested in partnering with people who can bring clients along with them. We're not going to participate in that being an aggressive takeaway from somebody else. But people often have a book of loyal people who will follow them wherever they are and whatever they're going to do. So that's the kind of thing we'd be interested in playing with. Henry, would we be interested in investment ISPs or mixed bag? Guys who got investments, health, risk. Do you want to have a go at that?
Yeah, I mean, often financial advisory practices have significant health and risk businesses attached to them as well. And of course, we're interested in those because they're natural feeders into the investment side of the business and vice versa. So it's something we would certainly look at.
Let's kick back to one or two investment things. We've got about 5 minutes left. Maybe just there's a few questions. Outlook on Discovery Bank. We think that's quite an interesting play. Maybe ask Liam to comment on that. And then what financial services businesses in the listed space does Anchor like? And maybe you can cover what we own in our equity fund.
Sure. So, I mean, Mike, also please jump in here. But in terms of Discovery Bank, I'm optimistic on it. Discovery has demonstrated an ability to create this like ecosystem that rewards shareholders of Discovery as well as their clients. I think it's the right approach, and I think looking forward, I think that it's got a chance to take quite meaningful market share in the niche sort of discovery segment of the market, which is your higher LSM in South Africa. I'm optimistic that they are able to succeed more also because if they're able to implement this in other markets around the world, I think that it opened them up as a global champion in terms of the type of banking model that they want to operate. But I would caution that by also saying, going back to that discussion on banks, it requires a lot of capital. A lot of back-end systems, there's going to be teething problems along the way, and also a lot of capital. And a lot of capital for Discovery is not necessarily the thing that investors want to hear, because this is a business that's been quite aggressive in terms of their accounting assumptions in the past. So there's probably quite a tricky period that they need to navigate now around accounting and making sure that they're expanding the bank in an appropriate way, that they're balancing shareholders' interests at the same time. But hopefully we look back in 3-4 years' time and there's a really good online only banking offering in South Africa, and South Africa is able to keep up with the rest of the world in terms of those types of trends, because that's what's happening everywhere.
And then what are our favorite financial services shares? Maybe to run through what we hold in the equity fund.
So what's going to come through quite strongly in the equity fund is a quality bias. So we own a company like FirstRand, it would be our preferred bank. We own a business like Transaction Capital, which is a mid-cap play in South Africa. But, once again, it's demonstrated over time that it's been a consistent deliverer, a consistent compounder in South Africa, and the quality is coming through. We'll own a company like Discovery and a company like RMI, because Outsurance is in its own segment of the market is once again, the best in class. And I would say that Discovery may be a little bit more controversially because of things like aggressive accounting policies at a bit of a lower weight. But once again, what we would consider one of the higher quality insurers, particularly around their future growth prospects. So those are the types of businesses that we would favor in the financial services in South Africa.
Maybe just one point I would add there is, why do we not own Standard Bank and Absa and Nedbank, for example? And I think it probably talks to a concern that, yes, there's probably a short-term recovery bounce, as I alluded to earlier. But, beyond that, we feel that they're very much a play on South African GDP, probably minus. And I say minus because the sort of emergence of the telcos as financial services disruptors, Discovery Bank, as Liam was talking about earlier, we think are sort of chipping away at a lot of those, particularly the fee components of where these banks are getting their returns from. And that's undermining their growth potential and undermining their potential return on equity, which we spoke about as being such an important issue. So, you can see a clear bias in the names that Liam spoke to around those that have strong franchises and are able to generate those high returns. They have good moats and good growth potential. And that's a big distinguishing factor that we look for in our selections.
I think another interesting aspect is, Liam sits in London, gets a lot of exposure to the emerging market management team come through there. And Russia's been a particularly interesting one. And South African banks are viewed in the context of global valuations. And the same global emerging market fund manager is comparing Capitec with, say, something like a Tinkoff in Russia. Maybe just a minute or two, Liam, on how you view our banks relative to the other comparable emerging market banks in terms of returns and valuations.
Sure. So what I would say is that over time, South Africa, in the context of emerging markets, has commanded quite a big premium rating. So, for instance, if you went to go and buy the equivalent of a standard bank in Brazil, it's going to appear cheaper. I think that there's, and Russia for that matter, I think that there's like quite a big trust deficit that has formed over time between, some of the more riskier emerging markets, if you want to call them that, that has never really gone away. And unfortunately, South Africa is now starting to fall into that camp where, because of, if you're investing in emerging markets, you're looking for growth, riskier type of growth. So that if the emerging market's not delivering on the growth, the rating starts to erode away. So while it's not necessarily an indictment on management teams because they can only operate in the environment that they're given, and banks tend to correlate quite tightly with GDP, the rating premium that South Africa has commanded is starting to erode and starting to trend towards the sort of mean of emerging markets. Russia, there are some optically very attractive valuations, particularly in the big banks. So something like Sberbank, you can buy it on a very high dividend yield, and the growth prospects are actually probably even better than South African banks. But the complexity around things like sanction risk with Russia has to always be taken into account. So Russian stocks optically appear attractive all the time on basic valuation metrics. And South Africa is not yet at that point that it's getting penalized to the extent of something like a Brazil or a Russia. But once again, we're stock pickers, and we're able to look at those markets and there are challenger banks that have come in. Brazil's got an incredible array of challenger banks, not necessarily listed at it right now, but there will be in the near future. So there are examples of the status quo being challenged, and I would point to the big one in Russia that's kind of snuck up on the market more recently, but we've been following for the last 3 years as a sort of gold standard in terms of challenger bank. It's got a very similar story to a Capitec, except it doesn't have the branch model. But Tinkoff Bank started off as a purely online lender, but in the higher risk lending segment. And as it's matured as a business, it's branched out into various different forms of revenue. And it's got a very high return on equity, very similar to a Capitec in that it's undercut competitors in those markets. The market recently has started ascribing a higher multiple to the business, and it's been added to Kathy Wood's ETFs as well in the fintech fund. I would also add Discovery is in there as well. So they're very interesting, very bottom-up specific stories, which is way more in our sort of DNA than trying to make the bigger macro calls. There's definitely very interesting opportunities out there. And I guess the experience that we had with Tinkoff, we applied basic principles that we had taken from Capitec and the Capitec experience and applied it to something like a Tinkoff, which is what's the advantage, I guess, of using the multi-geographic sort of view of things that you can do. Yeah.
So to tie into that, there's a question.
If I could ask you to pick two more questions. And we are over time. If you could just do your best to pick 2 or 3 more questions. And we will get back to you on the mail on the ones that we haven't been able to get to today.
So talking about those kind of disruptive banks is a question about Timebank. which is sitting in the African Rainbow Capital stable, does it have the chance of be competing at the highest level? And I think it's got a vision of being something like a Tinkoff, a big disruptor. Still very early days for it. It's got a lot of customers, up to 2 to 3 million customers, but the guys can't really do transactions more than, I think it's a limit of about 20 grand. So it's operating at the bottom end of the market. And I think quite capital challenged. They've just got a big investment of about R1 billion. But yeah, I think it's one to watch. And it ties back into, and I'll let Mike handle this, an opinion on Investec Bank, where you've got the old established banks and you've got a lot of these guys biting at their heels. And I don't know if Time's going to be successful or not. What they certainly are going to do is take some potential clients away from Investec, as will Discovery, as will Capitec, etc. So we've been kind of long-suffering shareholders of Investec. We've backed the valuation story. It's been a fairly good investment of late. But Mike, maybe you want to just give an update on how we're viewing that.
Yeah, I mean, just perhaps one word on what you're talking about now, Peter. Most of the bank executives that I talk to are in a cautious way highlighting the challenges that Timebank faces. We'll see whether it lives up to those. But I think that, I kind of asked myself the question whether Discovery would have actually embarked on creating a bank knowing what they know now, if they went back in time. So, every time I speak to them, I get the sense it's proved a much harder journey than they expected. Onto Investec. Yeah, it's a difficult investment case. I mean, it's essentially a bank that has tended to fall between the cracks, neither fish nor fowl. It's not really an emerging market play for people looking for that, and it's not a developed market play either. So it's been a difficult one in terms of finding what investor group it actually suits. It's also, I think, been exposed post the global financial crisis as a bank, particularly in the UK, that I don't really think has a big competitive advantage. Add to that the fact that it's, pretty much every year found another reason to pull another skeleton out of the closet for the last decade. And frankly, long-suffering investors, I think, have started to give up on the story. That said, we are of the opinion now that after really what's been quite a kitchen sinking exercise over particularly the last 18 months, it's come to the end of that process of cleaning up its history. With Brexit now out of the way, hopefully South Africa on the road back now in terms of its COVID issues, geographically it's in a better position than it was. Valuation very attractive as well. If you back out what's a decent wealth manager and see what the bank is trading on, may not be the best bank in the world, but it's probably trading on a price to book of about 0.2 or 0.3. So an interesting special opportunity turnaround story that we think's underappreciated by the market. And you probably don't have to scratch too hard to find 60, 65 Rand of value very easily without requiring perfection from Investec at all.
And then we're out of there.
Yeah.
And it gets to 65, it's hard to sell. I think let's wrap up with one final question. There's quite a specific thing, which maybe you want to pose the question and answer it.
Yeah, it was a question from Mark Dale talking about potentially buying the book from another financial advisor on a vendor financed basis. So in other words, through an income sharing arrangement. And you've also spoken about a poor quality book and a three times earnings multiple. So Mark, I think what you're talking about is essentially a vendor finance deal with a profit warranty arrangement, which is fine. These work in the case of a lower quality book. Yes, I think a 3 times earnings multiple is probably appropriate. But I guess the benefit when you're approaching a larger financial services firm, and I use Anchor as an example in this instance, is that the vendor financing element isn't necessary. So they'll typically have the balance sheet to do the deal now for cash. Profit warranties may still be applicable, but at least then you don't have this awkward sort of income sharing arrangement where the seller is actually funding the buyer into the business. So that would be the benefit of transacting with a larger player as opposed to an individual operator.
But I think, we talk you through the P multiples. If it's an individual business with an earnout, clearly there's no growth because the person's gone.
Yeah.
Getting to that 3-4 times P multiple thing is about right. So Dale, I'll hand it back to you. I think that concludes what we wanted to talk about. Thanks for listening, guys. And hopefully we've added some value to you, your practice and your investment outlook.
Thank you very much. Firstly, I just want to thank you all for attending Essentials. It's wonderful to see the base growing. Thank you very, very much to our speakers, and thank you for giving of our time. Just one or two housekeeping issues. It will take us, you will get your CPD points. Please give us 2 or 3 weeks for it to come through. Also, if we haven't covered any of your questions or you'd like to chat further or directly to any of these speakers around any of these issues, please do mail me directly. A copy of the presentation will be sent to you as your email address. Thank you very much, and have a wonderful day.